Hello and welcome to this first video on healthy trading habits. In this video we are going to cover the topic, don't follow the herd. Before we start, please read our risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, this is me. My name is Justin Paolini, Head of Trader Development here at FCI Markets. What I want you to know is that at FCI Markets, we want to give you the tools to become consistent traders. We want to help you simplify your trading habits. And also, our final goal is to train you and expand our own trading desk at FCI Markets, either on premises in the UK or remotely from home. We can fund consistent traders and take you from being a retail participant to being a professional financial markets trader. So on to today's lesson. Don't follow the herd. I find that the MyFX book Outlook charts are an extremely useful educational tool because they show very clearly what most traders do, and most traders are punctually wrong with what they do. So I've taken this example on Aussie CAD. This is a bit off the beaten track. Most people don't look at Aussie CAD, but in the recent times, Aussie CAD has been one of the best trending instruments. And thanks to this, it is also one of the most educational examples that I can show you in recent times, now into July 2020. This is what I mean by herd habits. In aggregate, most traders tend to fight trends. So as you can see, as Aussie CAD was trending down before the real decline into the coronavirus scare, most retail traders were positioned long. And then, as the trend changed, most retail traders started to be positioned short in aggregate, and they have been fighting this trend all the way up. So the worst herd habit, which is the first thing you really need to invert in order to come out with a successful trading plan, is to not fight trends. You need to trade trends. So why exactly do these people fight the trends? Is it because they don't employ stop losses? Is it because they don't honor their stop losses? So, they put one in the machine, but they move it. Or then they remove it and they place it higher up. Do they continue to fight the trend with multiple entries for whatever reason? Do they average down? So do they throw good money after bad? The mindset here would typically be if Aussie CAD was a sell at, for example, 0.88, then it's an even better sell at 0.92, or it's an even better sell at 0.96, where we are now. This absurd reasoning. Do they hold losing trades, hoping that the market will turn around? Whatever the reason, just stop. Because these bad habits consistently keep traders on the wrong side of the market. So let me give you a couple of tips. And I want you to know that these tips may seem simplistic, but apparently most traders need to be told again and again. So let me give you a simple way to stay on the right side of flows. Now, there are different ways to measure a trend. There are different time frames. There are different tools that you can use. What I'm giving you is just one consistent way to do this. And this is based on many years of being a trading coach, many years of trading the markets myself, and also now at FCI Markets, being in touch with professional traders that have traded at the highest levels of the industry. So this simple advice works if you will only have the discipline to follow it. So what am I showing you here? All I'm showing you is market structure in the terms of highs on the way down and swing lows on the way up, and a simple moving average. Now I have a 50-period moving average in here, and this is a daily chart. Most traders are not professional traders, as in they can sit in front of screens from 7 in the morning till 7 at night following the markets. So I'm showing you a daily chart because number one, the daily closing prices and also the weekly closing prices are very important to understand market sentiment and where the market is directed. But also because for most objectives out there, for most people out there, trading from a swing approach is probably more suitable than trading intraday or trading shorter term, simply because you have day jobs and you have other things to do and you need to dedicate a very limited amount of time to your trading. So what I'm suggesting is simplistic, but it works because professional traders don't use overly complex tools. Professional traders use relatively simple tools and they just use them consistently time and time again. So how can you identify the trend? How can you face the right way before entering your trades using a simple daily chart, highs and lows, and a moving average, in this case a 50 moving average? Well, here's the thing, you need to have patience. The trend changes when you start to have usually two higher lows. And remember that things have to be evident. I mean, if you have to stare at your chart for more than 10 seconds, then there's probably nothing there to see. And instead, these higher lows were very evident. So you need these higher lows because you need the market to show you that supply is being overcome by demand. So there are buyers coming in and buyers coming into the market, and they are starting to rotate the actual price structure. So once you have the second higher low, you can start to trade to the long side. And then as the swing lows are honored on the way up, so you have the higher low and then the market rallies, and you know that as long as the market does not violate this higher low, then you are still to trade to the long side. So after the pullback, you could keep trading to the long side, and now you have a higher low. Okay, so the market remains in the uptrend so long as this higher low is not violated. So the market pulls back, you're looking for your trade entries above this higher low, and the market continues and makes yet again another higher low. The market rallies and then it pulls back, but once again it makes yet a higher low, and so on and so forth. Here the market went a bit choppy, indistinguishable lows. So in this case, it's a bit too difficult to call, so you just remain flat. Don't trade unless you're already positioned from lower down and you can hold on to your trades. And then finally the market continues to rally, and it has been rallying, although very slowly and with some kind of consolidation up till now, but it has not violated the previous higher low. So the market still remains a buy on dips. Okay, and instead back here, the market was obviously a sell on rallies. Lower high, lower high, lower high, lower high, lower high, until this violation. So this is where you stop. But you didn't have any structure on the way up here, okay? You had volatility, but no structure. So there's no trade. And then the market falls back through these lows. So you're short once again. And then it makes a lower high, so you're still short until the market violated that lower high. So you're neutral. And the market prints a higher low. So you're neutral and waiting to see what it does. The market rallies, and then it prints a higher low, so you're starting to get long here. And then, of course, when you cross the moving average starts to slope up, confirmed by the higher swing lows on your daily chart. You continue to bet to the long side and not to the short side like everyone has been doing here. Fortunately, there are a few people that are trading to the long side, but they're always the minority. And educational tools like this have been around for a long time. Some retail brokers have published their retail positioning data for a couple of decades now. And yet these bad habits continue to pop up time and time again. Once again, the key here is to face the right way, and is to take a robust daily chart and follow the swing lows on the way up, the swing highs on the way down, and you can have the assistance of a simple moving average if you want to keep you visually on the right side of the market. I use a 50, you can use a 20, which will be much closer. The choice is personal as long as you know what you're looking at. Now, I know your objections. Okay, many people will say, look, the trend is mature. Aussie CAD is moving up for months now. Surely it's going to turn around. Okay, that's true. The trend is possibly mature, but it's a possibility. The trend has not turned around yet, and we don't know when it's going to turn around. I don't care what anybody tells you, you cannot predict the future. So until momentum and the swing highs and lows start to turn the market around, I will remain long on Aussie CAD. The other objection is, oh look, reversal signs. There are people, let me scroll back up to that chart, there are people that will continue to look for reversal signs saying, oh look at this, oh look at over here, oh look at this, oh look at this. They will be looking for reversal signs anywhere, anytime one appears after a little upswing. But the fact is that it is very difficult to have two mindsets. It's very difficult to trade both contrarian and to trade with the trend. And my suggestion is that you trade with the trend instead of using the contrarian mindset, because that mindset tends to get people into trouble. So instead, follow trends. Be patient. Wait for the pullbacks, and then get into the market. I mean, even the simple oscillator that I plotted here, this is a CCI, but you could do the same job with a stochastic or with a MACD. Just wait. As long as the trend is up and as long as the market is honoring the higher lows, just wait till extreme readings when the market's oversold. Look for your entry signals. Look for your typical entry signals when the market gets into oversold. And you notice that usually the decent pullbacks are highlighted by the oscillator being an oversold within an uptrend. It's a classic trend trading technique, but evidently people don't use it because it requires discipline and it requires consistency. And these are two things that I believe withhold people from getting anywhere in their trading. And then the third objection is usually, well, what if I miss the turn? What if the market turns without me? What if the market reverses and it goes far and I'm not on it? Well, so what? The market did something that was not within your game plan. The market did not show you what you need to see in order to take a trade. If, for example, you're using a game plan like this, only trading pullbacks within an established daily trend, then when the market does something like this and it starts to turn, or the market goes into neutral, it doesn't really matter, and it can't matter to you whether it goes 100 pips, 500 pips, if it does not present the situation that you need in order to either short the market or take the market long on pullbacks, for example, then you don't care because it is not presenting the edge that you are exploiting. And then, from a coaching perspective, the tough question. So you bring all of these objections, and my question would be, well, what if you continue to trade like you are right now? What if you continue to fight trends? What if you continue to try and pick tops and bottoms? What is that going to do to your account? What is the result? Now, somebody much wiser than myself said, you can't expect to have different results if you do the same thing time after time. If you want to be a consistent trader, you need to change your habits. It's not a question of feeling good or being right. I know it might feel great calling a market top, but ultimately, unless it puts money in your account, it's useless. Now, if you need any guidance, at FCI Markets, we're here for you. The first thing I suggest you do is just subscribe to our Thought Leadership blog. I write blog posts in there each week. I write morning calls and weekly calls to keep you updated with what's going on in the markets and to transfer my trading knowledge to you. The second thing I'd like you to follow is our Twitter channel, and that's FCI Ltd UK. In there, myself and my colleague Kevin Conlon, who has been at the highest levels of the financial industry, we populate the Twitter channel with low frequency, high quality information and chart analysis showing things that we are seeing in real time. There is a lot of noise that is spewed out every day. We try to filter through all of that noise to only give you the signal. Now finally, I teach a professional trading academy at FCI Markets, and the one objective of this academy is to grow traders that can come and trade our capital at FCI Markets. So if you need guidance, if you want to improve your trading and you don't know where to get started, then just get in touch with us here at FCI Markets. Either write us to our email or call us or just come to our headquarters if you're in the UK, because we are happy to hear from you, and we hope that you will become the best trader you can possibly be. This is Justin Paolini for FCI Markets, over and out.